creative real estate financing methods can provide a huge boost to running your business and building your portfolio, if you only knew what they were. Well, I'm gonna let you in on some right now. You ready? Let's go. So do you need some money for your next investment deal? I mean, maybe you are just starting in real estate, or perhaps you have been investing for a while, but your portfolio is now at a standstill. Regardless of your situation, there are several creative real estate financing methods that can jumpstart your real estate career or expand your existing one, if you know where to look. And I've got several creative ideas to share with you. For starters, as the name says, creative financing, you're limited only by your own creativity. But these 10, or a combination of any of them, will get you started. And by the way, if you're still looking to get that first deal under your belt, I put together a free training just for you to help you get that first deal done and then earn $5,000 a month flipping contracts and properties working in as little as 1 hour a day. And you can access it at mattsfreetraining.com. In real estate, the term creative financing is used to describe any type of financing arrangement that doesn't involve a conventional mortgage. Now, the most basic definition of creative financing is an unusual or innovative way of structuring a loan to buy real estate. And what most people don't realize is that anything goes. I mean, a seller has the right to sell their property for whatever they want for it. I mean, if they trade their house for a bucket of hot wings, they can do that. And that would certainly be creative. And as soon as I find a seller willing to do that trade, you'll be the first to hear about it right on this channel. And if you're not subscribed already, might want to do that because you won't want to miss out on the house that I bought for a bucket of hot wings. Creative financing has been around for as long as people have been buying and selling real estate. But it became more common during the late 70s and early 80s when the 1973 oil embargo crisis plunged the economy into a period of hyperinflation. And the Federal Reserve attempted to counter the hyperinflation by raising interest rates. Now, prior to the oil embargo, mortgage interest rates hovered right around 7%, but they jumped up to 17%, pricing most home buyers out of the market. I mean, a payment on a $200,000 mortgage at 17% would be right around $2,800. On that same mortgage at 4%, you're looking at just under $1,000. Big difference. And because it was more difficult to qualify for and even afford a loan, the need for creative financing was born. And if you're ready to buy that next investment property, but traditional banks are accusing you of being a less than perfect candidate, whether it be because your credit score is low or you don't have enough in the savings account to afford a 20% down payment, the following 10 creative financing methods could be exactly what you're looking for. And these are only a starting point because the sky's the limit when it comes to creative financing. If you're ready for me to run down all 10 right now, let me know by smashing the like button. Super, appreciate you for that. The first one, cash out refinance. A cash out refi for real estate is a transaction in which you tap into the equity of your home. You borrow enough to pay off the mortgage of your home and then pocket the difference, which frees up your funds to invest elsewhere. What's more, a cash out refi happens to be one of the best real estate financing options out there if the numbers work. A real estate cash out refi is different from an equity line of credit in which you add a second mortgage to your home to take out cash. The interest terms on a cash out refi are much more favorable than a traditional home equity loan. And unlike borrowing money from a hard money lender, the interest on a cash out refi is tax deductible. The risks with the cash out refi are that your mortgage term gets reset. The 30-year clock starts over again. And if something unforeseen happens, such as an illness or job loss, those new monthly payments can be challenging. But if you have a great opportunity and need some money to make that opportunity happen, it can be a great source of investment dollars. Second, the home equity line of credit, or commonly referred to as a HELOC. Unlike a cash out refi, with a HELOC, you don't pay off the original mortgage. Instead, you borrow against the value of your home, up to 80% of the home value minus the amount of the mortgage. HELOCs generally have a draw period, typically lasting 10 years or so, and a repayment period, often lasting no more than 15 years. So, when would you use a HELOC and not use a cash out refi? Well, a HELOC is perfect for doing repairs, either to your primary home or a rental property. Also situations where you don't need huge sums of cash for an entire property purchase. Maybe you just need, $10,000 to improve a bathroom in your income property. If you need more, and for a longer term, option one, the refi, would probably be the better option. Number 3, a personal loan. Though a personal loan doesn't offer the same great tax benefits as a refi or a HELOC, there are some compelling reasons to consider it. For one, you likely won't be required to put up your property as collateral. In many cases, you aren't even required to put up any collateral at all. And with a repayment term much shorter than a mortgage loan, 5 to 7 years is a good benchmark, you're going to end up paying a lot less interest over the long term. However, with that shorter repayment term comes a much larger monthly payment. You most likely have to have excellent, or at the very least, good credit to qualify for a personal loan. And don't ignore this if it sounds like no duh, because it can be an effective real estate financing method that's needed to get that particular deal done. Number 4, seller financing. So if you ever hear an investor talk about buying something on terms, they're referring to seller financing. As any seasoned investor will tell you, the ultimate goal is to use as little of your own money as possible and instead rely on other people's money. Seller financing, or seller carryback, is an excellent example of this philosophy. In this method of real estate creative financing, the seller of a property agrees to hold on to the note of purchase. You then pay them a monthly payment until the note is paid off. I mean, think of it as an IOU to the seller. Now, this is easiest with sellers who own their homes free and clear and don't mind foregoing a bit of short-term cash for some long-term streams of passive income. Motivated sellers who are underwater with their mortgage and/or payments, probably not gonna work here. Seller financing happens to be my favorite creative strategy in the toolbox, by the way. Happens to be most of my private REI Ace clients' favorite strategy too, as many of them are building cash flowing portfolios using almost exclusively seller financing. Number 5, the lease option. A common school of thought among real estate investors is that it is always better to buy than rent. The problem with this sentiment is the word always, because it ignores the fact that lease option contracts are a very viable route to buying property. Real estate investors of all experience levels may occasionally encounter a property that they're not ready or sometimes able to purchase, which is where lease option contracts can make for a perfect fit. A lease option property allows investors to work with property owners so that they can purchase the property at the end of the lease agreement. This allows investors to build equity through monthly payments and provides landlords with the opportunity to generate some passive income. Depending on the specifics of the contract, a portion of the rent payments will then count towards the down payment on the property. The most prominent challenge investors face when searching for a lease option contract is finding the right landlord to work with. This setup is most commonly introduced when an owner has difficulty selling a rental property. But that's not to say it can't happen under other circumstances as well. Investors hoping for a lease option scenario should be prepared to shop around and know how to approach the conversation when they find a potential property. When involving the seller in your creative financing, whether it be seller financing, a lease option, subject to, or a wrap, it's all about the presentation. And this is something I work extensively on with my private REI Ace group. If you'd like some more information on what it would look like to work together one-on-one on your presentation and overall business, go to reiace.com, answer a few questions, and then you can pick a time for us to hop on the phone and just brainstorm some ideas about you and your goals and specifically how to achieve them. Number 6, self-directed IRA. Investors with existing retirement savings can consider yet another creative way to buy real estate through a self-directed IRA. This technique allows investors more control compared to other retirement options and several tax benefits. It is worth noting that all returns must flow directly to the IRA instead of straight to the investor. Depending on your preference, this can either be a pro or a con. What is important to remember is that a self-directed IRA can allow investors to amp up their retirement savings, one property at a time. While a self-directed IRA is largely beneficial, there are always risks involved when it comes to investing. If you don't already have an IRA, the setup process is relatively straightforward. Research different options and closely examine the fee structures involved though. You want to make sure your cash flow covers your account's required costs and with enough returns left over to be lucrative for you. Number 7, private money. Private money is what I like to refer to as relationship money, due to the relationship between the lender and the lendee. A private money loan can come from your friend, a family member, your neighbor, a coworker, or essentially anyone else you feel comfortable asking for money from. Here you'll be able to negotiate more flexible loan terms with your private money lender because the entire transaction is less business oriented. And here's a tip for you though. Especially if asking someone you know for a loan sounds a little daunting. Rather than asking them for a loan, offer them an opportunity to make more money with you than what they're likely doing with their money at the moment. Number 8, hard money. A hard money investor frequently was at one time a private money investor. They liked the results and they just decided to make a business out of it. While the terms of hard money can vary greatly from loan to loan and lender to lender, there are several traits that almost all hard money loans possess. Firstly, the approval requirements for a hard money loan are much less stringent than that of a traditional lender. The lendee's income does not have to be verified, nor does really their credit score. Secondly, hard money loan stipulations can vary. Term lengths are typically shorter, interest rates are typically higher, and hard money can often fund a deal in just a few days. Lastly, hard money lenders understand the process of investing in real estate better than traditional lenders since their specialty is real estate. You see, instead of analyzing your credit score and asking for references, hard money lenders will review your rehab blueprint, your scope of work, and the ARV to determine loan terms. Basically, they look at your deal to determine whether or not it's worthy of a loan. 9, FHA loans. These are backed by the Federal Housing Administration, and FHA loans are perfect for first-time homebuyers who don't qualify for a traditional loan. While you are still technically borrowing from a conventional lender, this loan allows those with credit scores of 580 or above to pay as little as 3.5% for a down payment. Now keep in mind, you'll initially have to live in this property to qualify, but when you're ready to move, it can become a super income property for you. And number 10, crowdfunding. This financing strategy, it's relatively new and allows investors to use money from the public. Several well-known crowdfunding platforms like GoFundMe and Kickstarter authorize users to raise money for anything that they want. However, a website like Feather the Nest is a crowdfunding platform designed specifically for real estate investors and home buyers. Create an account, make your case to the public, and just wait for the funds to roll in. A traditional mortgage can be a great way to purchase real estate, but a creative way could be, and often is, much better. If you'd like to take that first step and dive deeper into creative financing, I've got a series of free lessons that break each one of these methods I mentioned into greater detail. You can get them all for free at creativefinancing.us. That's it for now. Thanks for watching. Take care.